Hello and welcome to the Biz News Breakfast Briefing. I'm Lucy Ferreira for biznews.com. In today's show, we have inspiring highlights from Dr. Frans Cronje, former CEO of the IRR, who, for the first time in over a decade, feels optimistic about the future of South Africa, which he says is on the brink of a political reformation, the likes of which have not been seen since the 1980s, believing that the South African economy is heading for a post-ANC rejuvenation come the 2024 elections. And then following those highlights, we have the Global News Daily Update from our partners, the FT in London. First up, though, it's Alec Hogg with his Daily Market Report.
Thank you, Lucy. Good morning. Today's Thursday, the 28th of July. Well, I let that run a little longer because it deserves it. The Nasdaq Composite Index up 4% last night. The S&P 500 up 2.5%. And that came on a day when the Federal Reserve raised interest rates in America by 0.75%, meaning that we now are having the most rapid rise in interest rates in the United States since the 1980s. When rates go up, it's done to cool down the economy, in this instance, to get inflation under control, and generally that hurts share prices. Shares have been in a bear market now for 2 years, if you want to have a look at what happened to the S&P 500 index last year. So what is happening is being interpreted as a bear market rally. All of our market prices that we put into the Daily Insider newsletter are in the green. Apart from the S&P 500 and the Nasdaq Composite going up, we saw the Rand strengthening overnight. We're at 23 cents higher against the US dollar, 16 Rand 67, 8 cents better against the pound at 20 Rand and 29, and 13 cents better than the euro yesterday at 17 Rand and 2 cents. The Brent crude oil price is up $1.10 at $107.96 a barrel. The JSE All-Share Index was literally 2 points higher at 68,424 as against 422 yesterday. The gold price, $20 better. That also jumped after the Federal Reserve announcement, and I'll get into that in a moment. That's at $1,737 an ounce. Bitcoin was up 10% last night. It's now trading at 23,263, and that augurs well for the Jaltech basket, which was already up 5% yesterday, edging above 400 Rand per unit. So what happened? Well, the Federal Reserve Chairman, Jay Powell, told reporters, and I guess anybody else who was prepared to listen, that the Federal Reserve in America will act more aggressively to tame inflation, but that the American economy has not gone into recession. He said, how can it be in recession if 2.7 million people got jobs, new jobs, in the first half of the year? However, he is strongly committed to bringing inflation down to 2%. Remember, in June, the American inflation rate was 9.1%, so that's a heck of a change in the inflation scenario, and he is prepared to raise interest rates until that happens. So how does the market interpret this? Front-ending of interest rate hikes, the biggest interest rate hikes in America in decades, will bring inflation under control, is what the market is believing, and that the increase in rates is going to be short and sharp, and next year inflation will be down so much that the Fed can start cutting rates again and getting the economy moving. Stock markets look 18 months ahead. There you have the picture. Two big stocks that released results yesterday were Microsoft and Alphabet, and the market interpreted the numbers as not as bad as anticipated. And then last night, we had both of those shares increasing very sharply, and they seem to pull the other big tech stocks along with them. Amazon was up very strongly last night. That was up by 5%. Apple also had a good session. That was up 3.5%. And our favorites, Cloudflare, 6.5%. Tesla, 6%. The wherever you looked on the board, it was stronger. And that, of course, translates into a Nasdaq Composite improvement of 4%, as mentioned earlier. Last night, we had financial results from Meta. Now, Meta's share price was up 6.5% ahead of the release of the results. In aftermarket, it fell 6%. And the reason for that was that for the first time ever, Meta, which used to be known as Facebook, has shown lower revenues than in the same quarter a year before. It was 10% worse than Wall Street's expectations, and clearly the stock was given a hiding in the aftermarket. What we've been saying about Meta is that the focus there needs to be on virtual reality. They are investing heavily in it. In fact, they've lost nearly $6 billion in the first half of 2022, but they might be getting to see some light there. The headsets have been increased in price by between 25 and 30%, depending on which virtual reality headset you are buying. Remember, at the moment, Meta completely dominates this market, both for headsets and for software. However, nobody is going to increase the price of headsets if you're not having the right kind of growth. So there could be a glimmer of hope there either way you want to look at it. But when you see the existing business that is not going well, particularly Facebook, the advertising on Facebook was down in the past year, whereas Instagram's advertising was up. But there are big problems on Instagram already. Some of the influencers saying, stop trying to be like TikTok, go back to the old Instagram. It's an interesting story, but where we are right now is that Meta, which has about 22% of the global digital advertising market, is not growing in the traditional business. The big bet there is on virtual reality, or certainly that's what's happening internally, and the way we see it, it is an opportunity to look at a whole new area. But the share price not reacting well in the aftermarket to the financial results that were released. Much better news from Spotify. This too, like Meta, is in the BizNews portfolio. That share price went up 12% during the session yesterday. Spotify's results coming out before the market actually opened, so analysts were able to make their calls there. The reason for this is that paying subscribers were up 22%. Advertising revenue was up 31%. The exponentiality of Spotify continues. Podcasts are still showing double-digit growth. Everything seems to be going in the right direction there. They did show a loss at Spotify of 125 million euros. However, the important number, when you take out all the accounting adjustments, free cash flow, went up, and that's in the positive of 37 million euros. The market loved it. We love it. It'll be interesting to see how that one reacts in the trading tonight, because we saw that with Microsoft and Alpha, there was also a delayed impact, which pushed it higher.
And now, please enjoy the highlights from Alex's interview with Dr. Frans Cronje.
Dr. Frans Cronje, it's good to see you in the flesh. Goodness.
It's very nice to see you.
It's been a year since we had our last interview. More than 100,000 people have watched it. So there's great anticipation, not least because a year ago, after being the arch bear almost on South Africa, you were quite optimistic. Now it's 12 months later, you're doing new stuff. Maybe we should start with that. You left the IRR and you've ended up at a small think tank.
Yeah. Well, in part, I left the IRR in very good hands. So amazing people there, fantastic new CEO, John Endres. I was there for almost 20 years, so you must go before they ask you what you're still doing hanging around. I'm on my own now, run my own group, doing advice on things. And on the side, a small group of us have put together a little think tank. It's very small, very modest. It's not the IRR scale of operation. It's a small band of people who are very interested in what is happening in the country and in identifying solutions. It's called the Social Research Foundation. And what it does, it produces proposals on policy for the country, sends them out. It doesn't seek a great publicity or noise or the cut and thrust of public debate. Sends that out to key people who make decisions about South Africa, diplomats, businessmen. Any person who's interested is very welcome to read.
Apolitical?
Entirely apolitical. This is pure, this is straightforward, the policy solutions. And then a second part of it is what people think within the country. A lot of analysts don't stop to ask people, what do you want? And the South African public is, as ever, they've always saved the country when it's in trouble. They've always made the right calls at the sort of great T junctions that we reached. South African public is very astute. And if you're able to produce policy proposals and understand what people want, to see how the two resonate against each other, we hope that the SRF will have a small influence in helping South Africa through this transition that it's in at the moment. But your opening was, I was optimistic a year ago, very optimistic now. I made a lot of calls that were right over the years. Yeah. And it was quite hard 15, 20 years back. We could see that the successes that had been achieved in the first decade as a democracy were starting to become brittle. And we could see just at the end of that Mbeki era that South Africa was set up for a harsh couple of years ahead. And that's very difficult because people saw the high growth of Mbeki. There was the stable business, government and labor sort of a tripod that existed, a budget surplus. Imagine that. It happened here. We doubled the number of people with jobs in the first decade as a democracy. Service delivery was looking pretty good. And we could, for various reasons, anticipate how this would go wrong. And so for about 10 or 15 years, we sounded pretty down in the face of undue and often ill-informed optimism. And that was very hard. It was difficult walking into those rooms. I walked into those briefings and I kind of thought, maybe I'll just tell them it's all going to be all right. But it wasn't, it would have been dishonest. And so we said, listen, we're headed for serious trouble. There was a lot of naysaying and you guys are pessimistic and nonsense. All that works in the world of analysis is that you look hard at the cold data and trends and make a call on that. When I spoke to you a year ago, more upbeat on where things are going.
That was just after the riots in the KZN.
Just after the
in fact,
riots.
Days after it.
Days, yes. Days after. The same methodology that made us get those calls right a decade ago, 15 years ago, same methodology in place today, and I think we are actually looking pretty good. We are near the point, potentially, of a transition of significance comparable to that of what we went through in the 1980s and the 1990s. Of course, historically, it's not as significant, but I think it's there, and I think I could make for you today a very sound case that South Africa's prospects are looking up.
So the Phoenix is rising. It's looking better. December is going to be pretty traumatic for the ANC, but 2024 will usher in a new dawn for South Africa, a true new dawn, with or without Ramaphosa at the head of the ANC. Is that, in a nutshell, what you're saying?
If they're way down and the coalition is in command, Mr. Ramaphosa will have exited by then. The upside case is 2024, we get a broad coalition of parties to stump up 55% or so of the vote. They are able to work together on key issues. They realize that they possess certain segments of the voting market. They're, of course, competitors too. I mean, one way I've put it to some of them is that, South Africa's big retailers are competitors. But the retail CEOs do not spend time insulting each other. I mean, they're competitors, they respect each other, they work together and they compete. And I think if the political culture becomes similar, of course it's my competitor, but actually collectively we all have a much greater responsibility to rescue a society in which half of people live terrible third world lives of poverty and desperation. I think the key ingredient is exactly that, the ability of South Africa's opposition leaders to work together. If you get that together with the kind of numbers we're seeing at the moment around pragmatic centrist policies, then we will be standing on the brink of a great reformation. And in the decade after that, you will begin to see recovery. And I know one input I'd add here is I think there's a very important role for the technocrats of the Mbeki era to come back, because they did well with what they got from the Nats, 13 years from the Nat deficit to a budget surplus. I mean, whatever you say about these guys, and they screwed up a lot, that was a hell of a thing. If that old Mbekiite, I don't want to, sometimes people say you shouldn't say it's the Mbekiite era, but let's say the first 15-year eras, technocrats were able to create a vehicle also to be politically relevant in a future coalition. Then I think the prospects are sound, that we could anticipate a recovery here of the same nature, trajectory, intensity as what we saw in the 10 years after 1994.
Frans Cronje, with his new Social Research Foundation. Always good to have him here with us. I'm Alec Hogg from biznews.com.
Good morning from the Financial Times. Today is Thursday, July 28th, and this is your FT News Briefing. The Fed delivered another historic rate rise, and Wall Street stock prices jumped higher. Soaring gas prices in Europe are adding to fears of recession, and the Twitter takeover saga is wearing down employees. I'm Jess Smith, in for Mark Filipino, and here's the news you need to start your day. The Federal Reserve yesterday doubled down on efforts to fight inflation. It raised its benchmark policy rate by 0.75 percentage point for the second month in a row. But Fed Chair Jay Powell also signaled that the tightening could ease, and U.S. stock markets rallied. Here's the FT's Colby Smith on the market's reaction.
Well, it was a bit confusing because in very few parts of Chair Powell's press conference did we hear any real capitulation about the Fed's commitment to raising interest rates and to stamping out inflation. But there were a few moments of dovish signaling in the press conference that I think markets really seized upon. In particular, when Chair Powell said that forthcoming interest rate increases may begin to slow. But that being said, he was quite explicit that if larger than usual rate hikes are necessary and warranted by the data, that the Fed would not hesitate to do so.
Colby, why did the Fed still raise rates so aggressively yesterday when we're already seeing signs the economy's cooling?
Well, the cooling of the economy is almost exactly what the Fed wants to see as it steps up its fight against inflation. So the Fed is not expected to kind of take into consideration any of the activity data well into the second half of 2022 when we start to see some of those inflation figures rolling over. Because right now, they're kind of firmly focused on ensuring that inflation comes down from here. And Chair Powell admitted yesterday that they probably need to see an economic slowdown and they probably need to see a cooling off of the labor market in order to achieve their goal.
What else struck you as notable about Jay Powell's comments?
One thing that was noteworthy was the way in which Chair Powell talked about the September meeting. Now, in previous policy meetings, the Fed has been really clear about what it will do at its next gathering in order to ensure there's no volatility around that outcome. And Powell, stopped short of giving that same guidance. He said that we could see yet another 75 basis point hike. We could potentially see something even larger. And he was not very specific about where policy is going, at least over that time period. Economists have seen this as an important departure, at least the beginnings of one, from forward guidance. And it'll be interesting to see if the Fed sticks to that approach through the second half of the year.
Colby Smith is the FT's U.S. economics editor. The drama of Elon Musk's fraught plan to buy Twitter is taking a toll on employees at the social media company. Twitter is now suing Musk to try and force him to follow through with the deal after Musk said he wanted to back out. Now the two sides are bickering over the start date for the trial. Meanwhile, the FT's technology reporter Christina Criddle has been talking to frustrated employees at Twitter.
There's been quite a lot of exits. They've also cut a lot of jobs at Twitter. So it's kind of like internal employees have given up on leadership and they've taken to messaging in sort of private message groups, one person said, rather than on the internal systems. because they're just so fed up, and they're saying they get asked about their end of year goals, but they have no idea what the company is going to be like at the end of the year.
How is this affecting the company's business, especially the advertising business?
Advertising is a huge part of Twitter's business. It's what makes them money. But some people that we spoke to said advertisers are pulling back as well from Twitter. So doing less ads. I mean, that's against a general backdrop of advertising spend going down because of the macroeconomic climate. But one person I spoke to said that he'd seen a 14% drop in the number of creator ads on Twitter since Musk said the deal was on hold.
Christina, is the frustration among employees at Twitter across the board from what you can tell?
I think it depends which employees you are. Some employees are big fans of Elon Musk and hope it goes through, but I think it's the instability and the uncertainty that's really affecting morale. Some people like Musk, some people don't, but not knowing what's going on either way is what's causing this kind of unsettled feeling amongst employees.
That's FT technology reporter Christina Criddle. Russia keeps cutting back on its gas supplies to Europe, and European gas prices are soaring. Yesterday, they jumped as much as 13% higher, and that's now adding to the risk of recession in Europe. Here's the FT's Martin Arnold on how European governments are responding.
Well, they're doing as much as they can, and they're doing many different things. So each government is trying to source as much alternative sources of supplies of gas as they can. And they're also working on reducing gas consumption as much as they can. And there's now this week a European Union proposal which is going to be implemented for countries to reduce their gas consumption by 15%, which will free up some of the gas supplies to be used to fill the storage capacity before the winter heating season, which is absolutely crucial because that's when gas usage really increases as everybody needs to heat their homes in the cold winter.
Martin, is there a sense that these measures will be enough?
All of that will not be sufficient if Russia completely cuts off the supply of gas, because Europe has made itself so dependent on Russia in recent years that there just isn't enough alternative supplies readily available, because most gas has to come through pipelines, and you can't just build pipelines quickly overnight. So really the fear is that Russia will weaponize the supply of gas, cutting it off completely before the winter hits, and that will force Europe to start rationing gas supplies particularly to heavy industrial users.
What do these rising energy prices mean for the risk of recession in Europe?
Well, we will find out a bit more about that on Friday, when we will get both the latest GDP figures for the Eurozone, and also we'll get inflation figures. The Eurozone GDP figures are expected to show that growth is at best stagnated, perhaps slightly positive. But the problem is that economists expect things to get even worse in the second half of this year, as inflation takes its toll on consumer spending and on demand, and also fears about a Russian gas supply cutoff really start to bite in industry and in terms of just in general confidence terms.
Martin Arnold is the FT's Frankfurt bureau chief. Inflation is in the news a lot for obvious reasons. But before we go, we have a story about falling prices for avocados in Australia. Turns out so many Australian farmers planted avocado trees, there's now a glut of the fruit. They used to be seen as fancy, but avocado prices have dropped to about $1 each. The Australian Avocado Trade Group is now looking for new overseas markets that can take the surplus from this avalanche, as it's being called. One grower told the FT he doesn't regret adding to the glut. He says everything tastes better with guacamole. You can read more on all these stories at FT.com. This has been your daily FT News Briefing. Make sure you check back tomorrow for the latest business news.
And that's all from the briefing for today. If you enjoyed this episode, please remember to like, subscribe, follow, and share wherever you like to listen. And remember that you can find today's highlighted interview and so much more on biznews.com.